state election counting going on today, and we have seen quite a change in momentum as far as Haryana is concerned. The latest numbers from Haryana are showing a much closer fight than expected. In fact, we are looking possibly at a split verdict. Now, the BJP at 43 seats out of 90, remember 45 required for the majority mark, the Congress and allies at 42 seats. This same picture just a few minutes ago, and I would say maybe about 20-25 minutes ago, was completely different. So as the rounds of counting of votes has continued, the BJP has made quite a spectacular comeback. Remember, we still are waiting for the final results to be declared by the Election Commission, but having said that, we're looking poised for a possible hat-trick, a possible third term of the BJP if they're only 2 seats short. The INLD Plus has 2 and others have 3. The JJP, which was an ally of the BJP, has not opened its scorecard at all in this round of state elections. Now, why have we been talking about Haryana, and why is it something that the markets are also looking at? Haryana is the first head-to-head electoral contest between the BJP and the Congress since the last Lok Sabha elections. This is why it was also being watched very, very carefully. And the results of this are also going to be extrapolated to see what the national mood is, which is why Haryana becomes crucial and these numbers become crucial. In fact, let me pull up and show you what the market has been doing in the last 20 minutes, corresponding with the change in the kind of numbers that we're seeing coming out of Haryana. And that is quite interesting as well. The recovery on the Nifty has been phenomenal. Look at that intraday chart. The Nifty now in the green. Pull up the Bank Nifty as well, and some of the other indices that we've seen, Nifty, Bank Nifty and Sensex, all of them showing fair amount of recovery. The Sensex also about 0.5% up. The Nifty Mid-Cap 150, beg your pardon, about 0.5% up. Now, we've been talking about Haryana. Let me also come back to J&K if we can. The Jammu and Kashmir election is also very important. It's the first one since the abrogation of 370 and, is really a testimony to the working of democracy in India. All 9 leads for all 90 seats is out now. The Congress-NC alliance, that's the National Conference Alliance, has taken the front row over here with 52 seats, and 45 is the halfway mark. So they seem fairly comfortably poised to form the government there in what is now a union territory of Jammu and Kashmir. But when it comes to Haryana, it's a different picture altogether. I would reckon that this is the important thing which has boosted the markets in the last few minutes. Quite a turn of events.
The Nifty intraday, as Tamanna marked, just shows how the market's mood changed completely. I think so. Twin effects today, this morning, right? China stimulus measures not quite enough. That gave a bit of a leg up. The Haryana election result close. So definitely a positive surprise from an incumbent party's perspective. So I think both of those factors have aided the market. So in light of this, before we get in our guests, let's just try and talk about the 2 or 3 things which should be top of mind as well. Remember, Mahindra & Mahindra has seen a good move today. I reckon part of it is because of the CLSA upgrade that is coming today. Puneet Johnson to tell us what are the key reasons in that CLSA node. Puneet, good morning.
Hi Niraj, good morning. So it's also, a very big upgrade that's come in from CLSA and Mahindra & Mahindra. They've upgraded from a hold rating to an outperform rating, and the target price has also increased from roughly about 2,650 odd rupees to 3,400 now. Now, do note that, there is a new analyst that's come in now, so that also might be one of the key factors. But the company, but the brokerage has highlighted that, the improved scale, superior mix, as well as a better pricing for SUVs has aided margins over the last couple of years for Mahindra & Mahindra. That's also backed by stronger launches of the XUV 700 and the Thar Rocks that we just spoke about. Now, upcoming EV models is something that they've highlighted that expects to spruce up M&M's SUV models, and as well as average selling price is also going to be increased because of this. They say that, they are keeping segmental EBIT margin guidance of about 9% over the next couple of years, which also leaves room for some consensus upgrades. Just on tractors, they have mentioned that, the last couple of years volumes have been flat largely, and that augurs well for the company because they are expecting domestic volume growth in FY26, and that's something that we need to watch out for. That's going to be one of the key drivers as well. Finally, what's the guidance? They've said that structural improvement in SUV market share, better product mix will also be one of the things to watch out for. And the current PE, the target price of 3,400 is based on the forward PE multiple of about 26 times of FY26. That's higher than the 18 times which was between FY18 and 22. But owing to companies, outperformance over the last couple of years, they've, given it a higher PE multiple of 26 times. Back to you.
All right, so CLSE on M&M has boosted at least M&M this morning. So some of the market movers after the first bit of trade, and that's what we're focusing on. Trent is definitely one of them. Mahima is joining us for more on that. Mahima, interesting note out from Kotak on Trent as well. That stock up 1.5%.
Yes, absolutely, Tamanna. So Trent has launched a lab-grown diamond jewelry brand called POM, and this they'll be selling in the West Side stores. Now they're expecting the rollout in the next 1 to 2 years, and this development reinforces a cautious stance on Titan now. What Kotak is saying that it expects direct or indirect impact of LGDs to weigh on Tanishq's studded growth and profitability starting from Q2 itself. Now what they're saying is that the brand POM offers LGD jewelry at a significant lower prices than natural diamond. The estimated prices right now of 1 carat solitaire ring are priced between 24,000 to 29,000, which implies an underlying retail price of around 15,000. So POM has potential. What Kotak believes is that POM has a potential to be Zudio of lab-grown diamonds in the jewelry market, and lab-grown diamonds somehow can disrupt every jewelry that segment that is present through Titan, that is Mia, Carat line, which is everyday jewelry basically, is what Kotak is expecting, and of course it will also impact their overall solitaire business as well. So this is the overall note, and in fact Trent, while Titan is not foraying into lab-grown diamond itself, Trent might use the back-end facilities provided by Trent to grow the lab-grown diamond space via the West Side stores.
Okay. Thank you for that, Mahiman. We'll come back to you in just a minute or so on Nykaa as well. Your call absolutely bang on how the street would view Nykaa's numbers. We'll come back on that. But the other big factor today, as Neeraj you mentioned, is China. So on the one hand, you have voters of Haryana, and the other hand, you have the Chinese planning body, which is moving the markets. And this is when you see interesting kind of trends coming in. But Chinese markets reopened today after a week, and completely with a bang, not necessarily in a good way. There was a very crucial meeting of China's top planning body, which came out and spoke about their vision on what they're going to do to boost China's economy. This has been described by most analysts as underwhelming. A lot more was expected. Shanghai is still about 5% up, but look at the Hang Seng. It's really been hurting, Nikkei hurting as well. The China versus India trade that now becomes a focus point. Remember, India was hurting, at least Indian equity markets were hurting, because a lot of foreign flows were getting pulled out of India and directed towards China. Is that trend reversing? Rucha is joining us now to tell us if India's outflows were becoming inflows for China and what we could see now.
Right, so the Chinese market reopened after 7 days of a holiday, and then let's have a look at how did the Chinese market fare before going into this kind of holiday. Well, the CSI 300 index surged around 25% just in a week's time, and the Hang Seng index surged about 9% during the time when the Chinese markets were closed. So this was a very good start to the Chinese economy in the morning, but we'll also look at how the Indian markets did. The Indian benchmarks however weakened in the same period. Nifty was off around 6%, 5.5% to be precise, from life highs made on 27th September. But then we'll have a look at the kind of FI selling that happened in India. Well, FI sold over 30,000 crore from the Indian equity markets in October. So this is largely looking out to be like the FIs are taking their money out of India and then putting into Chinese markets. But then if we can roll over to the next slide, we'll see that what kind of reforms were made in Chinese market. Well, but before that, let's move on. Let's talk about the Golden Week holiday. Well, October 1 to 7 were closed for the Chinese markets because of the Golden Week holiday, as I mentioned. And there were the latest reforms. There were 3 reforms that the Chinese economy, the Chinese central government made. Number 1 is that they lowered the reserve requirement by 0.5 percentage point, and this boosted the liquidity in the Chinese market. This was followed by the benchmark interest rates being cut by about 20 basis points to 1.5%. But the major reform was made in the housing sector. They removed the floor on mortgage rates, number 1, and they also removed restrictions on buying second homes. So this was a major stimulus to the housing market, and this also weighed on the metal index as well. The Chinese stocks actually gave up the gains as the NDRC underwhelmed at the briefing today morning. Well, the market was expecting major reforms in the meeting today, but that didn't happen and disappointed the street. Previous reforms were, however, reiterated. So that is negative is what the street believed in the morning, and that is why the Hang Seng Index actually slumped down to about 7 to 8%. But let's talk about what CLSA believes on Chinese and the Indian economy. In their model portfolio, they have raised China to 5% overweight by reducing their overweight on India to 10% from the previous 20% that they have. Now, this is on the back of 3 reasons, largely on valuations. They believe that the PE discount that China has in relation to India is at 53%. The PB, that is price to book discount, is at around 64%, and it also gives 2 times the dividend yield than India. So these are positives for the Chinese economy as against India. And they also reiterated 3 key whiches, as the CLSA pointed out. Number 1 is that the market is liable to be saturated by the new IPO issuances, that are coming in the Indian equity markets. Next one is that it also states that rupee is vulnerable to elevated prices. And lastly, we'll see that how SEBI has curbed the retail derivatives, and that could impact the participation of retail investors into the Indian equity markets. But lastly, let's talk about the positives of the Indian economy. Well, CLSA believes that this one is just temporary for the Indian markets, and India still offers the best emerging market growth strategy. As I mentioned, this does a temporary reduction is what the brokerage house believes. And lastly, in terms of ROE, that is return on equity, well, India's return on equity is better than China at around 15.5% versus 11% that China offers. But temporary, yes, in the near term, China is gaining at the expense of India, but this is just temporary is what CLSA believes.
Yeah, okay, and all of that has changed. I mean, things moving so quickly, Rucha. So all of that has changed actually in the last couple of hours because of some of the statements made from China's top planning body this morning, and that is something that we should focus on. As a result, metals doing fairly badly as well. But let's focus on what's happening with markets right now and look at HDFC Bank roaring, and that's really an interesting story to track. HDFC Bank completely pulled back after being hammered. Markets back above the 24,800 point. Obviously far from the lofty days of 26,000 on the Nifty, but looking at the way things have been going, I would reckon, Niraj, this is not half bad at all. And HDFC Bank leading that pack. Let's pull up top Nifty contributors just for a second and see what's happening there. Look at Adani Ports now. Top Nifty gainer, nearly 2% up, 1.5% up. So you have your back to basics kind of a mood this morning. HDFC, Axis Bank, HUL booming, L&T, so your infra plays, focus on old economy, banking, all of that coming back. Infosys, TCS hurting, and I think with a bond yield at 4%, that's going to continue to happen as US markets hurt. They're not out of the woods yet in the US, and that definitely is a pain point for Indian IT companies.
Yeah, and interesting. I mean, kudos to Himen. When we meet him next week, we'll tell him kudos, because he gave a call yesterday on buying into Adani Ports, Tamanna, at closing BTST call, and that stock is really doing well. So some of those brave calls have turned out well, so good going there. But not such a great day for Nykaa, unfortunately, and Mahima is waiting by to tell us about what the numbers were like. Also, what has the brokerage verdict been there? Mahima, soft performance by Nykaa. Is it warranted because of the quarterly update?
Absolutely, Niraj. So it has reported mid-20 net revenue growth in Q2. However, this is not in line with the FY25 guidance that Nykaa has already given in the start of FY25. Now, beauty vertical has seen mid-20 growth, but fashion vertical is only in early teens, which is why the stock is under pressure. Now, in terms of what brokerages are, interpreting from the Q2 business update, well, Citi has rated itself with a target price of 165. They're expecting revenue growth at 25%, and what they're seeing is that they're expecting EBITDA margins to be up around 100 basis points QOQ, but strong momentum in BPCs, but there is sustained weakness in fashion vertical is what they're saying, and they believe that 60 times EV to EBITDA valuation right now is reasonable as compared to the other traditional businesses and not the new age tech, the growth at which new age tech platforms are growing. Now, what they've said is that in fashion, they're building a growth of around 20% YOY, and they expect steady expansion in margins, but they expect decline in segment EBITDA losses, and overall fashion business remains under pressure. Now, Nomura and Nykaa has also retained it neutral with a target price of 203. They're overall expecting consolidated growth at around 26%. What they're saying is that Q2 expectations are lower as compared to FY25 expectations for revenue and margins, and they're seeing downside risks if recovery is not stronger in the second half of FY25. They're factoring a 29% growth in gross margin value of gross merchandise value of beauty and personal care, and in fashion category they're expecting weaker Q2 trends with 11% YOY growth in the gross merchandise value. So this is the overall view of the Q2 update, and of course why it's under pressure today.
All right. Thank you for that, Mahima. The big story this morning, and a few big stories actually this morning. It's an interesting morning for the markets. You've had narrative and statements out of China talking about what they will do to fix their economy. The street didn't take to it. And you had Chinese markets that have opened after a week, taking a knock to the chin. As far as India is concerned, two key state election results in focus, and what a turnaround on the state of Haryana in last few minutes. 48 seats for the BJP right now, Congress at 35. That's the latest tally that I'm seeing on the screen out of 90 seats. That means the BJP has crossed the halfway mark and now is poised to form a state government in Haryana for the third consecutive term. So much to talk about with our next guest. Completely excited to have you on air, Neelkanth Mishra, Chief Economist, Axis Bank and Head Global Research. And couldn't have asked for a better time to speak with you, Neelkanth. Thank you so much for joining us. I hope you don't mind.
Thank you, ma'am.
I'm going to take the liberty to ask you about the kind of election results we've seen, and let me contextualize it. The concerns post the Lok Sabha results have been that there will be a pivot to popularism or populist welfareism kind of policies. That may be the concern if the Haryana election result would have also seen the defeat of a BJP government there. Is that a concern now that goes back to the drawing board?
Frankly, that concern was actually misplaced. So we saw that the central government continued along its fiscal consolidation paths in the July budget. In fact, they further reduced the fiscal deficit. At the same time, what you will see at the state level across states is that more and more states are now offering income transfer schemes. So when Maharashtra did it in July, it was the 10th state in India to launch an income transfer scheme. In fact, both parties in Haryana, both parties in Jammu Kashmir, and now both parties in, or both alliances in Jharkhand are offering income transfer schemes. So the fact that at this stage of development in the economy, the growth in income inequality is given, there will be political response to it. So I think that's starting to happen at the state level. In aggregate, about, if you add the Odisha program, about 1.9 lakh crores, 1.9 trillion rupees, more than 0.6% of GDP, is the income transfer happening to poor women across 11 states. And now, after these state elections, maybe 13, 14 states will be added. More than 18% of India's women are now getting income transfer. So that's a separate thing. But if it happens at the state level, given that state deficits are capped at 3% of GSDP, I think at an aggregate fiscal level, that's less of a concern. So frankly, I would not correlate these results with the narrative on fiscal policy.
Okay, so fair enough. And you know, the fiscal policy and welfareism directed at women in households is not necessarily a bad thing. Maybe it is something that we need. Time to re-look at what we look at as bad welfare measures and good welfare measures. But just one more comment from you, Neelkanth, on the elections as they were. Why does this become important to track from a policy economy perspective? Because at the end of the day, it's one state. It's Haryana and Jammu Kashmir, of course, after 370 going to polls. But why do you think that the results become so crucial?
Frankly, their results are very crucial for the states of Haryana and Jammu Kashmir. I'm not convinced that they really have a big bearing on what happens at a national level. There are political issues about the relative momentum, how vociferous the opposition is, how the government thinks about the process of reform. But frankly, my own interpretation of this is that these have significant political repercussions. But as we think about the economy and the markets, they do matter for the people of Haryana and Jammu Kashmir. But for the economy and the markets as it relates to the rest of the country, I think the impact would be relatively minor.
Neelkanth, good morning. Niraj here. Trying to understand, Neelkanth, because it's a bit perplexing to try and decipher what China is doing and the resultant impact on markets and global economy. Now, there was a note that I read which said that maybe China is not trying to stimulate the economy, it is trying to stimulate the stock markets, and the economy might follow suit, or the confidence in the economy might follow suit. And today's comments in some people's terms were underwhelming from the NDRC. How have you thought about this whole piece and the resultant impact on Chinese economy and markets and Indian economy and markets?
Yeah, no, that's a great question. We all have to understand from a distance what the Chinese policymakers may be thinking about. I think what is very clear is that they are struggling with deflation. And we have seen, courtesy what happened in Japan, how bad it can be for the economy when deflation starts. So over the last 6-9 months, we've heard of spicy hot pot chains cutting prices, coffee chains trying to cut prices. And when restaurant prices start to fall, it's a very, very negative sign in the sense that it suggests very weak consumer confidence. It suggests deflationary pressures on wages. So I think the first, and given how much of debt that exists in China, this would be very dangerous. So the first objective of the Chinese government is, the Chinese policymakers, is to reduce deflation or at least bring back inflation, which is why the bazooka on the monetary side was very strong. And as you can imagine, because stock markets, equity prices are a financial asset, the impact on them was very significant. Now, when the challenge for the economy is aggregate demand, and the government has kind of given up on trying to stimulate consumption demand because that is generally fiscally messy, and maybe I'll come to that in half a minute. But they were, for a long time, trying to boost aggregate demand by getting housing to move. And over the last 2 years, 3 years, they've sort of de-emphasized that. Then a lot of the bank lending was going towards industrial capacity. It was growing at 25-30% a year. The loans to industry were growing at 25-30% a year. But over the last 6-9 months, we have seen that every single industry, from electric vehicles to battery storage to solar panels, all of these are very important sectors of the future. But the companies are now really bleeding, and so they are not interested in taking more loans to set up more capacity. And therefore, their base money growth is 12%. Their broad money growth, so M2 growth, is 6%. So there is, because loan growth is falling, the central bank is injecting more money, but the banking system is not creating enough because there's not enough demand for credit. Now, this is a very dangerous situation if you have such high levels of debt to GDP. Therefore, the first response they had was a very aggressive monetary one. The challenge is, and the problem is, that what the economy needs is a very strong fiscal response. Now, the fiscal response, and which is why the market is disappointed, is not coming through because fiscal responses or fiscal moves are generally very messy politically. because
Right.
what you're trying to do is take from one hand and give to the other.
Agreed.
Monetary is generally, there is a problem for savers if you cut interest rates, but given that there's so much financial repression anyway. So their objective is to get inflation back. I don't think they are now, given that unemployment is not a big issue and the population is falling, I don't think we should have expected a very big fiscal response.
Got it. So Neelkanth, if that is the case, what happens next? Since that has not happened, the call by some people is that there is a reallocation which is real and which will continue. I'm trying to understand from a market's perspective, do you think this reallocation is real and will it continue? And therefore, do economies or markets like India continue to suffer in this reallocation move if you indeed believe in the same?
I don't think the India sell-off by foreigners was directly linked to creating space for buying into Chinese equities. And frankly, even the correction we are seeing today is, if something moves up 25%, a lot of the people who were kind of anticipating this or had been stuck in it would try to exit. So a sharp move up and a sharp move down, frankly, it's not a sign of anything for me. The problems in India, I think, are also, I think in the near term, we are seeing the economy slow down quite meaningfully. Many high frequency indicators have worsened meaningfully in the last 4 or 5 months. And our expectation is that this is temporary. And as the government fiscal spending picks up, as the RBI is signaling that on the quantitative side of money, they are easing a bit, all of those start to flow through. The economy should revive starting Jan-Feb. But I think the result season is, I think, going to drive cuts in earnings. So some of what we are seeing in India is a reflection of our own weak economy and not so much about people just dumping India to buy China. Now, given that the Chinese government has shown, so far they were least interested in these things, given that they have shown that they want to bring inflation back and then stabilize the economy, and Chinese equities were very cheap. And therefore, some reallocation may be permanent. I mean, I don't think we will go back to those kind of P multiples again.
No, just on the point on the Indian economy, Neelkanth, early days in terms of the business updates we've seen. So, I mean, unless you have a view, I won't press you on that. But I'm wondering whether the rural recovery narrative and hope was a little premature, or is that yet to play out?
See, I have held a view for the last several years, and it's not a very popular view, is that the rural and urban divide is blurring. And this axis of rural is doing well or urban is not doing well or vice versa is something that analytically has lost value, in the sense that if someone, now that every village is connected to the nearby city, if someone picks up a motorcycle, and now every household seems to have a motorcycle for a large number of households, and goes to the nearest Mufassil town and buys something, is that urban consumption or rural consumption? I think what is more interesting is lower income versus upper income. And what we have seen in the last 4 or 5 months is that the lower income consumption, which was very weak, has kind of stabilized. The upper income consumption, so therefore, car demand, the demand for many of the consumer goods, retail sales in modern stores, those have actually were very strong and have actually started to weaken. What should we think about going forward? I think the slowdown that we have seen is because of a very negative fiscal impulse. Last year's central and state government spending was front-loaded. This year, central and state government spending is backloaded because of elections, and then some rejigs happening in various governments. But I think the spending pool is there, and as the spending picks up, I expect that the upper and middle income consumption will again strengthen. Remember that for the next several years, labor will be in surplus and capital will be in shortage. So we are going through that phase of economic development where the bargaining power of labor will be lower than the bargaining power of capital, and that's generally a sign that upper and middle income consumption will do better than lower income consumption. So that's an axis I find useful, and that's why I was never in the camp that this so-called rural recovery will happen. And I'm not surprised that it has been actually quite typical.
Yeah, but in terms of earnings overall, I mean, because that's the next thing that we all will move to and focus to. Where are you anticipating the weakness to really show, or the cracks to really show? Are you sharing the concerns about deposit growth when it comes to financials or to autos or some of these segments that have been quite heated?
So the second quarter numbers, so as the previews have started getting published, we have seen cuts happening to industrials, to financials, to autos, to cement, so several sectors. In fact, even consumer staples, many companies have seen cuts. Barring a few, like say jewelry, etc., where the growth has been, the quarterly top line updates have been slightly better than expected. I think everywhere we are seeing weakness. And so the cuts will be broad-based. But I must say that these will be backward-looking in the sense that as the RBI signals through persistent overnight surpluses or liquidity surpluses in the overnight market, and quite possibly as we see the MPC, the new MPC give its comments tomorrow, our expectation is that they will at least change the stance. And so as the monetary conditions ease, and this is the time where they should be easing, given that global conditions have eased with the Fed cutting rates. I don't think they will be cutting rates, like the MPC will be cutting rates, but on the quantitative side, I do expect some easing to happen. And that is why I think the bank earnings, the cuts that we have seen, should be more backward looking. Same for industrials. In our view, the capex cycle has turned, the real estate cycle has turned, the power generation cycle has turned. And as the launches, the pre-launches, and the sales start to translate into construction, you will see the economy getting some momentum back. So for many of these sectors, as the market starts to get worried about the pace of earnings cuts or very poor results for the September quarter, and frankly, I think GDP growth in the September quarter could also be very weak. For some of these sectors, what I would be actually buying into that sell-off, because I expect that with fiscal and monetary easing, the economy should start showing good signs of recovery by January.
Buying into the sell-off. That's interesting. Okay, Neelkanth Mishra, I have two questions. My last question is on metals. But before that, just linked to your current answer, I would love to understand. Economists are notorious for being a lot more cautious. You combine with aplomb the qualities of an economist and a market watcher too. I would love to understand, because I looked at your report, which on 17th October, right, wherein you mentioned that the global capex or the Indian capex cycle has truly started. Where is it that you believe there is a higher probability of consistent economic growth and investability options? Is it power generation? Is it real estate? Are there some other capex linked sectors which provide this?
No, it's a very important question. Before we see what is going to happen in the future, it's very important to understand what happened in the past. In fact, the growth slowdown that we saw between 2012 and 21-22 was, and the investment ratio falling from 34% to 27%, of that 7% decline, 5% was the decline in households' investment in real estate. 3.5% was government and public sector and private sector investment in machinery. And there were increases happening as the government built infrastructure and all. Now, so of that, so you can imagine that 5% of that 7% was just household investment in real estate. So I think that is the strongest change that I expect will drive the economy in the next couple of years. Anything which is a construction proxy, and I think with cement, the profitability being at a decade low, EBITDA per ton, currently the volume growth is very weak. I think the sector has been somewhat weak as a result of that. In our view, as construction picks up, I think that would be a good proxy. On the power generation side, any economy as it grows, it requires more energy. Incrementally, I think the share of electricity is going to be higher. And therefore, we are going to need a lot of capacity. In the last 7-8 years, we've not added much. Some of these stocks are very expensive. So maybe the current weakness in power demand, where we are seeing negative numbers in September and we saw negative numbers in August, albeit on a high base, can actually set the stage for some reasonable recovery as the next year comes closer. So these would be the sectors that I would look at. Some of the machinery stocks can also be beneficiaries of this. Not so much metals, because the steel in particular, I think given what's happening in China, given that the Chinese sort of desire is to just bring some inflation back and not really restart investments in real estate, and sales of real estate are down by 2/3. I think construction activity is going to fall off. I think the long-awaited slowdown in Chinese metals and steel demand is now upon us, and that's something that can be an overhang on the profitability of Indian steel companies.
I must ask you, Neelkanth, how you feeling about IT? This is supposed to be the recovery quarter. So much that has changed in the US markets as well. That has become a little positive. Do you think that flows in for Indian IT companies, or we still have to wait and see those green shoots actually show?
So the sector has already done pretty well. So as the inflows into Indian equities continued, even through the period of economic weakness, I think most domestic fund managers have already rotated into the defensive. So what we have seen over the last 4 months is that IT, staples, pharma, they've all done well, despite the fact that there is not any meaningful change in their earnings trajectory. In fact, staples earnings by consensus are still seeing cuts. Pharma earnings are not changed at all. IT has seen a bit of upgrades, but very, very minor, not justifying 25, 30 times forward earnings. So even if a recovery was to happen, while incrementally it would be positive news for the market, and maybe the stocks can respond to that, but I think the sector is really expensive. What has happened though, you're right, is that the growth prospects for the US economy have turned out to be, I mean, they're showing much more resilience than we had expected. We have to see what is driving this. Remember that in the last 2 years, their fiscal deficit has expanded quite sharply. So just like the sharp fiscal contraction in India in the last 4 or 5 months has driven a slowdown in the domestic economy here, it was the sharp rise in the fiscal deficit in the US economy, which actually has supported their growth. So we don't know if in the last months of the fiscal year, which is for them September, they actually had a much higher fiscal deficit. We'll see the data tonight. But there are several drivers there. I'm not convinced that the IT sector's volume growth numbers in the next year or two are going to be meaningfully better than what they reported, and which is why we are underweight the sector.
Absolutely. Thank you so much for your time. Neelkanth Mishra there, Chief Economist, Axis Bank, and Head Global Research at Axis Capital. Always a pleasure to speak with you. And great to have you on today on, I think, what is a very, very important day for markets to figure out what exactly is happening. We'll wrap it here, but we're closing off at least this leg of the show with the Nifty 0.5% up. But after this break, we shift our focus to the F&O side of things. Stay tuned, a lot more coming up on the other side on NDTV Profit.